that rising oil price and how that's filtering through to the petrol price this week, how that's going to in turn be feeding through to inflation. And in that regard, many saying thank goodness for the resilience we're seeing in the rand, keeping the unit at 3-month highs around about that 670 level.
I think just on that front, you need to emphasize the fact that you do see leads and lags when it comes to inflation, and particularly the disinflationary impact that the rand is having and has had in the past on both food and fuel inflation. Particularly now, we're probably seeing the impact that the rand had last year, around 6 to 9 months ago. So moving forward, we've probably seen the bottom in terms of that effect. Moving onward, we still have the view that we should see some type of interest rate tightening or interest rate hike in around the fourth quarter of this year due to the headline increases on account of the rising fuel prices. We have seen some type of easing in the Middle East, North Africa region, but as long as that geopolitical tension creates supply disruptions, we're obviously going to start seeing the oscillations in the oil price and that feeding through into the real economy.
What are you making of the lack of oscillation we're seeing when it comes to the rand, because it's holding pretty steady, and it seems that we've got a trading range of between 655 and 675 that's haven't been pegged out at this stage?
Well, not surprising if you look at the behavior of the rand, and it's something that we quite generally tend to emphasize. The rand gaps very quickly, and then it range trades in around a 10 to 15 cent range. And I think that's what we've seen. Last week we had quite robust data, specifically out of the US. We're sort of 2 years on from the Lehman's crisis, from the disaster in terms of the global recession, and yet we still look to the US for some type of direction, be it on a global front or even in terms of currency and risk trading per se. So I think on the back of the positive US employment data, the still very strong manufacturing data globally, we're seeing risk appetite being quite buoyant and that holding up the rand. But yes, indeed, cemented to the 670 position, and I don't think that you're going to see much movement. Keep in mind that the Reserve Bank is still very active in this market. They have a tolerance for rand strength, and if you were to see the rand going lower quite quickly, I'd be quite surprised.
Of course, we are anticipating those Forex reserves data out of the SARB. What are you expecting on that front as we look over what's happened to the local unit over this period?
Well, I think you have to put it in context of gross reserves versus net reserves. From a gross reserve perspective, we're probably looking at about a 1.2 billion rand increase. Now, that is also formed as part of the FX devaluation, around 200 million, and then you're looking at the change in the gold price. It comes down to the international liquidity position, so that's your net reserves. Outright in terms of naked intervention would probably be around 200 million. That's what actually the SARB would have bought. Keep in mind that in March, the rand barely moved. Also, very range bound. It purely moved at the end of the month on the back of very strong bond inflows, a trend that we haven't really seen since probably the fourth quarter of last year. So if anything, the purchases probably accelerated toward the end of last month. But the proceeds that we're seeing from the 2041 bond issuance, offshore bond issuance from the government, would probably be deposited with the SARB, and that would actually feed into your bottom line. So on balance then, your net reserves would only increase around 500 million.
Of course, we've got that carry trade position still getting quite a bit of attention, and things seem to be on the cusp of slowly shifting here, where we've got both the US and the ECB may be looking at tightening sooner rather than later. To what extent though? Because when it comes down to it, our rates still stand very much higher.
Very much so. I think when you're looking at international interest rate policy, it's still a very benign environment. Yes, we have had indication from the ECB that they will raise interest rates as soon as Thursday perhaps. The timing thereof and the sequential interest rate hikes is in question, whether or not they will proceed to raise by 25 to 50 over the next year, or whether they will stop in July specifically. And that is probably our expectation, given how fiscal consolidation is going to play out within the Eurozone, given that they're still sitting with a fiscal crisis on the periphery. Yes, Spain has largely decoupled from that sort of pig's stigma, but we're still sitting with 4 or 5 countries that are in trouble on the periphery. when you're looking at the Fed, you also have to put their interest rate policy into context.
Which is pretty mixed at this stage. No one really knows what that policy is and where it stands.
I think tomorrow the minutes of the Fed meeting won't be surprising to the market, in that now Fed Chairman Bernanke will produce a statement following the interest rate announcement. So we won't have to wait 2 or 3 weeks later in order to get the detail around it. That just sort of speaks to the credibility of the Fed, rather than changing their economic forecasts. For them, they still function under a dual mandate. So they're looking toward growth, and employment is a very big component of that growth forecast versus inflation. So we are starting to see some type of underlying inflationary pressure, but still very muted. The bottom line being that if you're looking at interest rate differentials, South Africa is still a high yielding economy, and we will still see cash flowing into the economy, specifically real income or real money investors who are now taking a buy and hold position. So you won't see a sudden reversal of portfolio outflows. And I think we saw that over the Japanese earthquake and even the Libyan geopolitical tension. There were intermittent bouts of risk aversion, but you didn't see money fleeing from South Africa and the rand pushing up to 750 or 8. And that really speaks to the fact that we're now being considered as a real money investment.